Hello and welcome to the Tuesday Night Stock Club. I'm your host, the president of ICLUBcentral, Doug Gerlach. Welcome. Glad you could join us on this Tuesday, March 2nd, 2021. Today, we're going to take a look at where we stand with the market year to date. We're going to take a look at the Toolkit 6 program to address a problem that some users have when dealing with particular types of companies. And then finally, we'll round it all off with a stock selection from one of our investing newsletters, the Investor Advisory Service. So let's begin. We're going to talk about where we are in this 2021 year to date as of today, the beginning of March. And here's where the three indexes that I track stand as of the middle of today. Down below at the bottom is the EFA index in red. That's the Europe, Australasia, Far East index, which represents global large cap stocks primarily in developed countries, up about 3% year to date, and the S&P 500 is up about the same amount shown in blue there. And the real story, the same as last month, is the S&P SmallCap 600 index, which is now up more than 17%, almost 18% year to date. So it's truly been a good run for small company stocks as we head into the third month of the year. The rest of the market's holding steady, but nothing to write home about. But those small caps continue to drive the broader market performance as we move through 2021. When we look at the broader market, the S&P 500's PE ratio still is at an extremely high 39.4 based on estimated trailing 12-month earnings per share. And that level, you can see, as indicated by the red dotted line, it would have been astronomical up until we reached the 1990s. It would have been unthinkable for the market to have a PE that high. Right now, of course, mitigating factors are that many companies have seen significant earnings declines or losses in the pandemic 2020 year, and the market is pricing in recovery, so it's maintaining the valuation as we go forward. But that PE ratio still very high. And again, the risk in pricing in recovery is that if recovery takes longer than the market is currently anticipating, that could drag things on and cause some unforeseen pullbacks in the broader market. When we look at the earnings of the S&P 500 on a trailing 12-month basis, you can see they have dropped off significantly from the year ago period. They had been as high as $104, now down to about $98, $99. Again, using trailing 12-month estimated earnings per share. So earnings continue to drive forward. This graph is a good representation and reminder of why we are growth stock investors, because the market will continually drive upward in terms of the earnings power of the companies that are the constituents of the S&P 500 and broader market. And especially when we focus in on growth companies, we're taking advantage of this upward trajectory as best we can. Also, interestingly, the S&P 500 dividend yield continues to drop off a little bit. It currently stands at about 1.5%, again, using trailing 12-month dividends for companies. And that is a level that is lower than just about any dividend yield level of the broader market, with the exception of just following the 99-2000 market crash. But any other period in time, going back to 1870, the market had delivered a much higher yield than it is currently. Again, part of that is due to what happened last year with a lot of S&P 500 constituent companies suspending their dividend or cutting their dividend, but those companies, the prices also fell, so the yield as a percentage of the stock price wouldn't be that affected. But the broader trend, again, going since the late 1980s, has been for companies to prefer not to pay out as much in dividends and to return money to shareholders in other ways, such as by buying shares back. And if you use your capital to purchase shares, you're increasing earnings, but you're not committing the company to pay a dividend on a regular basis. In Europe and elsewhere in the world, it's very common for companies to have a variable dividend rate. And a few companies have adopted that here in the US, but here, when companies cut their dividend or don't grow it fast enough or eliminate it, those companies tend to get a lot of unhappy shareholders. And so the practice has been to maintain the line on dividends, to pay them consistently, whether you can afford to or not in many cases. So everyone should be, who's investing in dividends, should be especially paying attention this year to your 1099s. Some companies maintain their dividend but didn't have profits to support it, and so a portion of the dividends that you received are actually returns of capital and not dividends, taxable dividends. And so again, that will reduce your tax liability for those dividends, but you need to pay attention to your tax reporting documents, and you might be a little surprised if you were chasing high yield stocks and discovered that they weren't actually all paying out dividends, but they were giving your money back in terms of return of capital. So I just thought this was an interesting graph, and that there's definitely been a downtrend in the last year on that yield rate. One other observation is that much of the methodology about investing for income, investing for dividend stocks dates back to the 40s, 50s, the post-depression years when Benjamin Graham was writing, and when he was looking at companies and devising the first rules about investing. It was a very different climate. Yields were much higher, 5, 6, 7%, were not uncommon. And so you could identify companies by their ability to pay out those significant rates and earn a decent rate of return. But as those rates have fallen, some people continue to follow a dividend investing strategy and love to collect the cash, but don't recognize that that's an increasingly smaller portion of your total return. So the dividend, again, not something that we chase. In the investor advisory service, out of 80 or 90 stocks, typically no more than 20 or so pay dividends, and the yields may get to 3% at the high side. So by and large, not a lot of dividend paying companies. And again, as a total return newsletter, dividends are fine, but you want to drive the biggest portion of your portfolio through capital appreciation. It's more tax efficient and will deliver a better overall rate of return as long as you can mitigate the risk. So let's do a little bit of talking about portfolio management. So this is a 15-minute crash course in stock portfolio management according to the better investing principles and my interpretation of them, how we use them in the tools we make at ICLUBcentral for investment clubs and individual investors, including Toolkit, including myiclub.com. So I just wanted to outline about 5 or 6 rules that I think investors should be paying attention to when you're building a stock portfolio. It's not just about buying stocks. If you really want to reduce the risk in your portfolio and increase the returns, then it behooves you to pay attention to some of these rules about diversification and managing your portfolio with a long-term perspective. And diversification is key. If you're not concerned about volatility, the propensity of your portfolio to bounce around in value over time, then you can ignore rules about diversification and you can put all of your eggs in one basket. That's easier said than done, and many people who choose that route end up not liking it. People say that they're very risk tolerant, and then they undercut that with actions that go against what they've claimed to have believed. Many investors fail to follow these rules, and so when we talk about sector and industry, better investing's guidelines are to spread out into many industries, and I'll talk about how many I think that is a little bit later. My rule of thumb is to watch out about focusing too heavily on retail stocks, consumer goods companies, restaurants, and healthcare. restaurants, retail stores, anything related to fashion, consumer goods companies, these are very consumer facing. In other words, that individuals deal with these companies. You shop at their stores, you shop online at their e-commerce sites, you use their products, their tools, their food, you eat at their restaurants. And as a result, you can gain familiarity and then mistakenly transfer that familiarity into a feeling of expertise about a particular business or a particular product. And that's not always the case. And in fact, that's one of the cognitive biases that often impacts individual investors, is that we overestimate our skill of analysis with things that we're familiar with, and that leads to poor decision making in many cases. Healthcare, I think there are opportunities, but again, it gets to be popular. I did have a friend whose husband had some heart problems, was wheeled into the emergency room and was on the table, and the doctors were addressing him and working on him. And all the while, she's taking notes and asking, so who makes that particular product, that particular drug, that particular tool? Was taking notes for her portfolio. Unfortunately, he was fine. He survived, and we had a good laugh about it later. But again, healthcare is someplace that I've seen where investors kind of double up. Now, that is, again, so it's just something to watch out for. There are plenty of opportunities in many of these industries. I have found that restaurants and retail companies tend to come and go, and the hot new store may be hot for a couple of years before it peters out. Fads and trends are really tough to incorporate into a long-term portfolio. You also want to avoid concentrating in too many sectors. Technology is often the culprit. Investors like tech stocks, and so they end up overloading in tech stocks. In the market crash of 2000, following the dot-com boom of the 90s, a lot of investors learned the hard way that holding too many tech stocks had a lot more risk than they anticipated. And in your diversification, my general course of action is to direct new research into finding companies and sectors and industries that I don't currently own. And so that's a way of guiding looking for new companies, is if you've got healthcare and consumer goods and financial services, and you've got technology and you've got communications, well, let's look at industrials and basic materials. Because part of the elements of diversification is that you cover different segments of American businesses or global businesses that perform at different periods and during the economic cycles. So we want to be defensive, but we also want to take advantage of the demands of the American economy. So that's my particular preference, is to attack it that way. In Toolkit 6, or my iClub, we provide sector and industry diversification graphs and reports that make it pretty straightforward for you to identify your entire portfolio diversification. Some people also will consider the international exposure or like to own international stocks as part of their portfolio. The thing to remember is that about half of the revenues and sales of the Standard & Poor's 500 companies come from outside the US. So if you own large cap or mega cap stocks that are US based, chances are a lot of their profitability is coming from outside the United States, and those figures are growing. Many companies are continuing to look overseas and add to that part of their business. So you might already be plenty well exposed to the global economy if you start looking at the underlying percentages of sales that come from outside the US of the stocks that you already own. The second diversification target is to diversify by company size. And here's a graph of Better Investing's guidance for looking at a portfolio and trying to find stocks that fit into your large, small, and mid-sized baskets. The companies are defined by revenues, not by market cap, because you can look at a company like Tesla that has an enormous market cap, but relatively small earnings or revenues rather. And so it's considered a large cap stock, but it might be a mid-sized company. When you look at companies by revenues, annual revenues or trailing 12-month revenues, we can categorize them by a fundamental characteristic that's not a popularity contest. So large and small should make, large companies are greater than $10 billion, small companies have revenues less than $1 billion, mid-sized or in between $1 and $10 billion in revenues. And Better Investing suggests 25% of your portfolio in large, 25% in small, and 50% in mid-sized companies. And this target is based on the propensity for large companies to have slower growth rates, but less volatility. They're more stable. They may be more likely to pay dividends, which will add, again, a little bit more stability to your portfolio. Small companies on the other side will provide more growth, but also more volatility. And mid-sized companies are right in between, kind of the sweet spot. Good growth rates, reasonable volatility. These are the emerging businesses that are going to be the leaders in the next decade, and they're eventually, hopefully, will become large cap stock or large companies, perhaps large caps as well. Toolkit 6 and My iClub both have company size diversification graphs and reports for your portfolio. Some people like to consider the earnings growth rates of companies as well. Based on your SSG, you can look at the, having some slower growth companies, some faster growth companies, mixing them all up. And one of the advanced tips that I will talk about when I visit with investment clubs is, can you calculate the average growth rate of your portfolio? And if you're a real Excel junkie, you can look at the dollar-weighted, revenue-weighted average expected growth rate of earnings for your entire portfolio. And that figure is essentially going to be your expected rate of total return. So if you have a portfolio loaded with 7, 8, 9% growing companies, the chances that you're going to outperform the broader market are pretty slim. And that might be fine for you based on your risk tolerance and objectives. But we like to give ourselves every opportunity at outperforming the market. And so having this good mix of companies by different sizes will allow us to outperform when we continue this performance over the period, a longer period of time. And then if you recall, when I started off looking at the year-to-date performance of small caps and large caps, that we're in a segment now, a period now where small caps are way outperforming large caps. So the small companies in your portfolio are maybe more in favor now than the large companies. And so if you're looking at your overall rate of return for your large cap portfolio and you're saying, gosh, I'm only up 2 or 3% for the year, that's perhaps a sign you should be thinking about adding a little bit more smaller mid-sized company exposure to your portfolio. So diversification is really key. Now, I believe that you can set up your diversification target, company size, industry group, and again, you can customize these things. Rules are there for to provide a basis for creating a plan, and experience gives you license to experiment, to adapt, to adjust. So certainly if you have 20 or 30 years of experience with this methodology, you may tweak those targets in one direction or another. A member of one of my early investment clubs that I was in, who was 70 years old, and he loved small company stocks, and his portfolio was loaded with small company stocks. And you would think someone who's 7 years old might be not quite thinking that far ahead in terms of long term. But he just loved it. He was comfortable with the analysis, could handle the risk, and so he was always driving for those new ideas. So you can really tweak it as much as you want. My ideal allocation target is that at least 7 sectors should be represented, and there are 10 to 12 sectors depending on your classification system. So that includes things like healthcare, communications, consumer defensive, consumer cyclical, basic materials, industrials. So those are the broadest market categories or categories of companies. And then within that, you've got industries, and there are 145, 150 different industry groups within the major sectors. My rule is that no stock or industry is less than 3% of your portfolio or more than 15%. And again, that target on the high end sometimes you have a single company that performs well, and now it makes up 15 or 20% of your portfolio. That's a great problem to have. Don't sweat it. You might, in those companies, as much as you say, gosh, well, eventually maybe they'll come back in price. They never seem to, those big winners. And so they can tend to skew your portfolio in many ways for a long time with that overweighting. I believe that no two companies should be in the same or very closely related industry groups. If you're really applying principles of diversification, you wouldn't own companies that are very similar. For instance, Adobe and Microsoft. Maybe those two companies, choose one or the other, but maybe they're both focused on businesses and business software, business services, and are probably going to be driven by a lot of the same trends. And certainly I wouldn't own CVS and Walgreens. Choose one if you've decided that you want to have a drugstore in your portfolio. So look at it from that perspective. Now, if you do have a overweighting in your portfolio, our approach, and I don't think Better Vesting has ever suggested doing a tactical rebalancing at year end, where at the end of the year you sell off your winners and you buy more of your losers, and you get your portfolio balance back to exactly the percentage that you want to be. This is an approach that financial advisors will often use in terms of asset allocation classes with their client portfolios. But I would rather take a more dynamic approach where you say, all right, we're out of balance, I'm out of balance, this amount, I have too much of this, not enough of this. Let's go see what we can find that will help bring us back into balance as we move forward, instead of automatically selling and buying at year end to bring everything back in line. So that's, and I think that's great for investment clubs as well, because you can set an agenda at that point. All right, we need for the next, for our goals for 2021, more small company stocks, more mid-sized company stocks. Let's look at these 3 or 4 sectors and see what we can find in terms of stocks that would fit into our portfolio and increase our risk and reward relationship. My rule number 3 is to not own too many stocks. The old rule was that, and if you go back 20 or 30 years, some of Better Investing's documents would talk about owning 10 or 12 stocks would give you good diversification. Newer research really suggests that 15 to 20 stocks gives you better benefits of diversification. And again, these benefits are that if you are spread out into a number of stocks in different industries and sectors, you're not going to be beholden to the problems of one segment of the market if there is some sort of disruption to a particular industry or sector. For instance, if you were overloaded couple of years ago, 2 or 3 years ago, if you were overloaded in energy stocks, they've had a tough couple of years, and you would be feeling the pain about those companies. But if that was just a small portion of your portfolio, you can look and say, well, gosh, from this point, the forecast for the energy sector in general over the next couple of years is, a bounce off the bottom and a pretty steep trajectory of growth and increasing stock prices. So again, if we can handle those types of swings, but that's what we want to try to avoid for the entire portfolio. Within the portfolio, you're always going to have 1 or 2 or 3 stocks that are underperforming, some industries that are not performing as well, others that are outperforming all your expectations. In a club, the rule of thumb is, you can't have more stocks than you've got in your than you have members to follow them, and so many clubs have a 1 or 2 stocks per member. If you have a small club, each might have to do 2 or 3 different companies, but you can still be diversified if you've got 15 stocks or 12 stocks, really. And with no stock being less than 3% of the total portfolio. Again, that's my absolute bottom floor. Any stock that you own in your portfolio that is less than 3% of the total, your total portfolio value. If you've got a stock, it makes up 2% or 1.5% of your portfolio. If it doubles overnight, you are now seeing a 1.5% gain in your portfolio value. That's noise. That's random noise, the amount of change that you're likely to see on a day-to-day basis just from stock fluctuation. But this is a stock that's doubled in price. Now, if that stock was 5 or 8% of your portfolio and it doubled overnight, now you're looking at a 5 to 8% bump up in total portfolio value. So concentration is good. Over diversification is bad. And the problem with owning too many stocks is that your returns regress to the mean. In other words, they become closer and closer to the average of the broader market, the more stocks that you own in your portfolio. Here's a graph that shows the total portfolio risk as a function of the number of stocks according to the standard deviation of risk, the percentage of risk. So that on the left side, you can see that if you own 1 stock in your portfolio, you have a high level of standard deviation. You've got a high level of risk. But as you add securities, add stocks to that portfolio, it drops and it drops and it drops. And you can see somewhere between 19 and 28 stocks on this graph. That line, the total portfolio risk is not really declining very much at all. The risk declines very quickly for the first 20 stocks. And then after that, it declines much more slowly. And as you get out towards 100 different stocks, you have your portfolio risk will tend to equal the market risk. This is why many large mutual funds don't generate outsized returns. If you look at the best performing mutual funds on a annual basis, they are often funds that own 30 or 40 stocks. Very few. They're very concentrated in their holdings, and that forces them to be diligent and forces them to be precise in the stocks that they select. They're not just adding, well, let's buy 100 shares and see what happens. Have you ever been guilty of that one? Let's buy a few shares, start a position, and we'll see what happens. Well, we know what's going to happen when you take a small position. One, it's going to perform well, and you're going to go, gosh, I knew it, I should have bought more. Or 2, it's not going to perform well, and you're going to think, gosh, I'm glad I didn't buy more. And the scenario in which you take a small position and then you decide to add to it, that becomes very difficult for a lot of investors. So it's much better if you do the research and you analyze the stocks and you make a decision and you say, all right, here we are. Now we are going to put several $1,000s into this company because we have done the work, we've done the homework, we've done the research, we've done the analysis. It appears to be one of the best opportunities we can find right now. Let's make an investment. So this is something that I think a lot of people need to pare down their portfolios, and that will help if you get rid of your underperforming companies. Tip number 4 is don't fear selling. We look at sell as a bad 4-letter word. Better Investing has the PERT principles, the Portfolio Evaluation Review Technique, which is a series of forms and a methodology of looking at companies on a quarterly basis, primarily focused on the trends or the quarter-over-quarter performance of sales revenue, but especially pre-tax profits. And that allows you to see companies that are continuing to generate positive results, but at a slower rate. And you can identify those with the quarterly trend graph in Toolkit or the PERT-A graph in the SSG Plus tool, but we think of it as a quarterly trend graph. We're looking at the trends of the most recent quarter. And if you address the companies with the concept not of selling, but of replacing any stock in your portfolio as soon as it appears they have a limited upside potential or any sort of problems, and you go out and seek a replacement, and you do this often enough, over time, you really will not be sitting around waiting for companies to return to the level that you expected of them or to generate an adequate return, and you're always going to be finding better candidates for your portfolio. And the other thing to consider is that overvalued stocks are as big a risk as underperforming stocks in your portfolio. Our practice is to let the winners ride, and that is to be true to be sure. We want to hold on to the best performing stocks as long as we can, but when stocks reach levels of valuation that are higher than they've been in the history, then we're really looking at a situation where there's just not enough upside and a whole lot of downside. And that's when we can start talking about using a trailing stop loss order to continue to capture gains, but to protect us if the stock sees a very rapid, fast decline in price, a pullback in price. We could exit that position. Even if though we're long-term, you can address risk with some additional tools in your toolbox. My approach is to consider upgrading your portfolio on a regular basis. And that is not against better investing principles. Better investing does not say, if you buy a stock, you are making a commitment for 5 years and you cannot leave this relationship with that particular stock. Leaving a relationship with a stock is easy. Just got to click the sell button on your broker's website. But instead of selling it, think about replacing it. Anytime you're disappointed with the stock that you've purchased, start thinking about alternatives. Challenge the company. Do comparisons with other companies. And chances are very good you'll find another company, and it might be a company you already own, that has a better return and quality outlook. And so by replacing one with the other, you can improve your overall returns and keep managing the level of risk in your portfolio. I like to remind people that patience is a virtue, but stubbornness is a vice. And if you're just not dealing with the problems in your portfolio because you're stubborn, that's a foolish thing to do. If you're being patient because you have optimism grounded in evidence, that's a good thing, and you can continue to be patient. But and being impatient, is also, we wouldn't recommend that you jump whenever a stock is not performing. But if we've got through a couple of quarters and the performance that you expected isn't there, it's time to take action. Number 5 is less of a concern these days with commissions at brokers continuing to fall. The old rule was the commissions and costs should be less than 2% for every purchase. Now that's well below 1%. But watch out, even though the broker might not charge anything. Again, I think it's foolish to buy 10 shares of a stock for $700 when the rest of your portfolio positions are $6,000 or $7,000, right? It's just too small, doesn't make sense, and that is enabled by free commissions, low commissions, no commission. You don't have to worry about a minimum purchase. But watch out for ADRs. Because often there are fees with ADRs. So if it might be $20 when they are paying dividends or annually, and that is going to be a cost that's passed on to you. And so if you have a very small ADR position, then you're being charged ADR fees. That it might behoove you to increase those positions or consider the cost and the relationship to your overall returns. When you have larger investments, that's going to force you to concentrate your energy into finding the best candidates as well. So I believe that you should have establish a minimum amount that you will invest in your portfolio holdings into a new holding. In a club, it might be you meet for a couple of months. Finally, you've got your first $1,000 or $1,500 or $2,000, and you're going to make a purchase. It's going to be many months before you have that same amount of money to make another purchase. But again, I would rather you did that than take that first $1,000, buy 2 stocks for $500, and then get your next 500, buy another 500. I would much rather that you kind of start off on a bigger level because it's going to focus you on being a little more committed. Number six, be tax smart about your gains and losses. Again, this is something that people tend to think about only at year end, but you can also take advantages, again, of some tricks that will help make the process of selling a stock much more reasonable for you. Whenever you're selling a stock, whether it's because you've got a lot of gains, or you're unsure about the future of the company, or some bad news has come out about the company, if you're selling at a gain, and you've also got a similar stock that's being held at a loss, that could be a great time to do a two for sale where you sell both of them. So you capture the gain, but you also sell the stock that you were holding at a loss. Your brain is wired to remember the good things, and so it will soften the blow of, gosh, why did I buy that stock? It cost me a lot of money. I lost a lot of money in it. But because you're gonna remember the gains that you made from selling the stock that was a winner. And likewise, if you're really having trouble pulling the trigger on selling a stock that's not performing well, it's got a lot of unrealized losses in it, then think about selling portion of a stock that's performed well. Not only will you net out the gains and the losses, and not have the taxable realized gains, it will minimize the regret that comes from selling losing stocks. And that can be significant, and that will often postpone the decision-making process for a lot of investors. They won't sell because they know as soon as they sell, they're going to feel bad. And then you contrast that with, well, if I just hold on, maybe in 6 months or a year, that stock might recover and go back to showing positive numbers in my portfolio, and then I would feel happy about it. And so the trade-off can be very significant, whether in your personal portfolio, in an investment club. And also always remember, if you do this, if you have a stock that you're selling at a loss, and you sell a stock that you've got at a gain, you can immediately turn around and repurchase the stock that you were holding at a gain. You've locked in the profits, and the tax impact of that has been negated by the capital losses, and so the clock resets essentially. So you're continuing to hold the stock at a gain, or you're continuing to perhaps earn more gains on the stock that you sold at gains there. It doesn't work the other way around. You've got to wait when you sell stocks at a loss for 31 days before repurchasing it because of the wash sale rule. All this brings us to the topic of harvesting gains and losses. Generally at year end, it's recommended that you look at your portfolio, and if you're sitting on stocks that are big losers or big winners, and you've got imbalances in your portfolio diversification, the smartest thing you can do is to harvest some gains and losses in equal amounts, offset each other, and then your portfolio diversification might be healthier. You might have more cash to deploy, but all in all, it's a smart way to get around the difficulties that many people have when selling, especially stocks that are underperforming. So something you can do with this at any point, and this might be a good summertime opportunity, mid-year opportunity for your investment club to do a portfolio review in December and another one in July, and just kind of look at the gains and losses and make some decisions about it, and that will help you at year end. When you're making these tax-driven selling decisions, it can be useful to think of them as temporary. You're not saying permanently goodbye, except to maybe perhaps some of the underperforming companies, but the companies that are performing well that you're selling for tax reasons, those can be good opportunities for you to think about taking new positions in those same companies, or only selling portions of the positions. We don't get into locking in your gains by selling the amount once you've recouped your initial. You sell the profits and let the capital ride. All those types of Wall Street derived rules are meant to separate you from your wallet in terms of broker commissions, and they have drifted into the lore of investing don't really think it's necessary. The wash sale rule you should be familiar with. When selling at a loss, you can't buy a stock, that same stock or security, until the 31st day. And so I often suggest to clubs, whenever you sell stocks for tax-related issues, so you're doing tax selling, automatically revisit them at the next club meeting to see if you want to reestablish a relationship with that company. But it doesn't apply to stocks with gains. So you can reestablish a relationship with a stock that you sold as gains the same day, the next day, it doesn't matter. You can wait for a pullback and say, well, if it comes back 10% in price, maybe that's a good time to buy back in, as stocks tend to bounce around in price as they go. Hugh asks, isn't the same thing if you replace or sell? No, it doesn't. It's not the same thing at all. When you sell a stock, you're going to cash, you're getting rid of the company, and often that decision is thwarted by your best efforts to protect your inner being, your psyche, from the damage that comes from having a fully acknowledged bad decision now on your permanent record. When you replace a stock, it's not quite the same thing. Now you've got, yes, you're continuing to eliminate the company from your portfolio, but you also are bringing in an exciting new component of your portfolio, something that you know. And if you think about the excitement, maybe it's nervous anxiety for many of us, but the interest when you finally find that company that looks to be a terrific bargain, the prospects look good, the numbers add up, and you buy that stock, that is a very exciting moment. And and I think, yes, it's much more exciting when you're just getting started, but I still think you've got that feeling of satisfaction whenever you click the buy button to buy a stock. And so the thinking is that positive feeling offsets the negative emotional side of selling underperforming companies. And so it makes it easier to come to that sell decision. Now, a lot of people learn that it's not good to be emotional about your portfolio. You shouldn't be attached to your stocks that you own, but that's often easier said than done. Different personality types will approach their portfolios in different ways. Often, there are people who see the numbers and they see the charts, and it's a no-brainer. Other people look at the story, look at the company, and they think about it in a different framework, and so it can be a different type of decision for them. So you need to find what works for you that helps you through the process. Marie says, what are ADR fees? If you want an ADR is an American Depository Receipt, or an ADS, American Depository Shares. These are foreign companies that trade on the U.S. on a U.S. exchange. However, they don't trade as their underlying shares. They trade typically as a basket of shares of the foreign stock, and that basket is known as an ADR. The basket might be just one stock, or it might be a one-to-one relationship. Often it's not. And so then the ADRs have a sponsor in the U.S., and this is a regulatory requirements, and so they're able to file and pay dividends, but there's an additional layer of management for these. You don't actually own a share of stock in this company. You own an ADR of the company, which represents shares of stock. So it's kind of a layer removed. And so some of these ADRs are charging fees on top of commissions when you make trades or receive dividends or have a distribution or a split or some other corporate event. And so it's something to watch out for if you are investing in ADRs, to understand that, because it's becoming more and more common, and I've seen some of them seem to be pretty expensive, and it's a fee. It might not be a percentage-based fee for you. All right, let's talk about Toolkit 6 now. I wanted to talk about adjusting the visual analysis graph in the program, something that someone recently asked. Sometimes when you pull up the data for a company, all the points, sales, revenues, or sales or revenues or pre-tax profit or earnings don't display fully on the visual analysis chart, page 1 of the Stock Steady Stock Selection Guide. Toolkit does have several features that can help you adjust the display in that visual analysis window. You can, in preferences, in the Stock Study tab, there's an option to initially to place the plot the lines on scaled or on values. The values mean that if you've got a company has $1.32 in earnings, that point will be on the 1 or the 10, or the 100 line, depending on how many scales are visible. $700 million in revenue might be on 770 or 700. All right, so that's what we mean by on values. Scaled means that Toolkit figures out the best way to put all the points on the graph, but they might not be in order, and they might not be on any identifiable scale. And that's okay, because we're looking at the relationships in the semi-log graph. We're not looking at the actual numbers. Now, when the form was paper, yes, it had a scale already in it, and you were plotting them by hand, so you needed the reference points of the 1, the 10, the 100, and those numbers in order to figure out where to plot the dots on the graph. When you're in the visual analysis window, you can set the graph to values. If it's not already used, if you're not using it so often, I use scaled as my option in preferences, and then we'll click the set graphs to values, and that will bring a display perhaps more in line. You can click on any series of dots on the connected line, and you can drag them with your mouse. And if you hold down the control key on your keyboard, click on the line, drag it to near where you want it to be, and let it go, it will pop to the nearest scale. So I'll demonstrate these, and we'll talk about them. So here's a graph, a new company brought in, and this is what it looks like in Toolkit. And it is obviously not seeing very much. And again, this company's got a lot of variability in earnings, maybe some losses in the 2020 fiscal year, a big drop off in 2014. And so all of the data is practically off the top of the charts. All right, so here we are, remember, in the visual analysis window. If you click Add Scale at the top of the menu bar, it immediately adds a scale, and it brings the sales and the earnings and the pre-tax profits points down into the window so that we can see them. So it's a pretty simple way to do it. You can add scale. You can click on that button 1 or 2 times. Sometimes you can click to add 3 scales, depending on where companies are initially. So that at least gets you to what you kind of expect to see, and then you can go ahead and say, well, okay, 2014 might have been an outlier year. 2020, we'll call that an outlier year as well. Figure out where your growth assessments are gonna take you from there. Second example, in this case, you can see down at the bottom that the pre-tax profit and the earnings in the most recent year were negative. So that means that the data is somewhere down below the bottom of the graph. But no matter what you do in this case, if you look at the data window here, all the earnings are negative. Now, they're getting slightly less negative as the company is progressing, which you might count as progress, but it is still not profitable. And so there is no way that you can show negative values on a semi-logarithmic graph. And so this data is not shown anywhere and can't be displayed when it's all negative. Negative points are always, if they're all negative, there is no series of lines. You're not going to see anything. And that should be telling you perhaps something about the company that you're evaluating, that it doesn't meet our criteria for a growth business at this point. It is still a loss business at this point. And perhaps it may increase down the road, but it's really difficult at this point to use the tool to evaluate this type of company. Here is another example where the data is all over the place. The prices are going off the top of the graph. The earnings and pre-tax profit are falling off the bottom of the graph. And so in this case, if we click on the add scale and click the set graph to values, we get a little better picture of it. Yes, apparently now we're going to see still some negative values prior to 2017, or prior to 2018 rather, but now we can at least address the last 2 years and the most recent quarters of this particular company's growth, and they've had a good year. So as evidenced by the quarterly points on the graph, the trailing 12 months have been pretty strong. In this example, again, we can click, control-click, drag the series around and have it pop to the correct nearest scale. And I'll show you that in a live example in a minute. And so here's another example. This is what it looks like when you bring the data into the program, and the data is off the bottom and the top of the graph. So in this case, we can click and drag to the right location. If you look at it here, you can see that the sales over here on the left is from 2012, 2013 is just skyrocketing. And that's the problem here. The Toolkit can't fit all of that, all of those growth points on the graph. But if we come over here with our mouse and click and drag it, we can pull it down. We don't need to see the 2011, 2012 sales figures. We know that they were very lower, but it's irrelevant to our analysis because that growth rate, those years, I would consider them to be outliers. Everything prior to, on this graph, prior to 2014 is irrelevant. Because it doesn't have an impact on where the company is likely to head from today going forward. So I'm going to ignore the lowest values on the left side, the oldest data, and drag things and make them a little more accessible. I'll flip over to Toolkit and we'll open that same company now, which happens to be Supernus Pharmaceuticals. So here we are in the program. Here we are. What I just showed you in the illustration, we can add scale, and we can add scale, but now we've got things kind of popping all over the place. We can click set graph to values, and again, the scales are way off. We can bring things a little closer together. So I'm going to click and drag pre-tax profit with my mouse here, and I'm going to drag it to where about I want it to be, which is at 160. 168 on the graph. I'm going to press the control key on my keyboard and I'm going to let go, and it pops right into that particular place. So it's right on the 168.6 point on our scale if you look over on the left. And I'll do the same thing with the sales line. I'll click, I'll drag it down to around the 520 point, press the control key, release, and now it pops right into place. Now if I want to, I can release and remove another scale, and everything is now nicely plotted on my graph. As I said, I would probably come over here and click on these couple of years and take them out of the equation entirely. This looks like relevant growth to me. That those years look not as relevant, and it's much older data. One other point here, a lot of users who were trained using the paper and pencil stock selection guide, going back to the 1990s, when the first computerized programs were introduced, were taught to display the points on the graph in income statement order. So sales, the top, followed by pre-tax profit, followed by earnings per share, with the price and the earnings on the same scale, or close to each other, so that you can compare where the earnings were relative to price. If the price is going up, or in this case, the price is going down, in 2017 when the price was going up. Well, we know that that was the year of the Tax Reconciliation Act, so those that year may be impacted one way or the other by tax changes, changes in tax code that impacted their tax rate. So that's how we can adjust things using the tools here, the add and remove scale, set graphs to values. So again, in this case, I clicked set graph to values and it just messed up everything once again. But I can find the sales and I can drag it back to where I want it to be. And if you wanted it to look, if you weren't concerned about the order, you could keep it like this. So we do this for the SmallCap Informer and the Investor Advisory Service stock studies. We present them in the majority of cases in this particular order. Now, occasionally there will be cases where you've got really rapid growth, and so it doesn't fit, where we might, or if they're, sometimes you'll plot the two lines, and they're on the same scale, and they're, it looks something like this, and so you end up trying to figure out how to display things, so that it makes more sense. But those are some tips. Some final thoughts, that negative values are never going to show on the semi-log graph, and it can really screw up. There won't be any trend lines. Terrence points out it's impossible to do a trend line from a negative earnings year. So companies where there are negative earnings last year, you can't have a trend line from that fiscal year starting point for the next 5 years. Sometimes I have been known to delete ancient history from the study. It's just irrelevant, especially if it was largely negative, because it skews the trend lines that are calculated. And often in those cases, there might be non-GAAP data available if you research the company, which might be more useful than some of the losses, especially if they're a newer business, might help you to interpret them a little bit better. All right, let me talk really quickly. I'm going to run through our stock of the month. And this month, we're looking at ADP, Automatic Data Processing, which was recommended in the March 2020 Investor Advisory Service newsletter. You can check out the newsletter at the investoradvisoryservice.com, and the promo code Tuesday will get you a nice discount on a subscription if you would like to read the full details of this and all the other stock picks in the newsletter. The ADP is the longest continuously covered stock in IAS history. Now, the analysts didn't know that I had done that research when they picked the stock, but I thought it was pretty ironic because I had dug back into ADP's history in the newsletter. It was first recommended in 1975 at a split adjusted price of $2.91. It was re-recommended in 1990. It was re-recommended in 1997, and the recent price is $173. So it just gets you a lifetime gain of 5,945% based on price alone for ADP since it was first covered. It was never discontinued or recommended for sale, and it was, as I said, it was re-recommended a couple of times throughout the years. So you're probably familiar with ADP. It was founded in 1949. The ticker is ADP as well. It's the largest global payroll processor now with 860,000 employer clients in 140 countries and territories around the world. It has 3 segments. You're probably familiar with employer services. That's managing payroll and retirement plans, worker benefits. That accounts for 65% of revenues. The PEO services division accounts for 31% of revenues. This segment is interesting because ADP for these customers becomes the employer of record and then leases the employee services back to the companies. So for many mid-sized companies, this is a great opportunity and cost-effective way of servicing their employee base, and it's a increasingly big driver of ADP's revenues. And then the interest that it earns on the employer payroll deposits makes up 4% of revenues. And this is money that's not held for very long, but before the paychecks get cut by ADP, the employers have to transfer the funds. And so ADP at any point in time is sitting on millions of dollars, and they are earning interest on those, and that made up 4% of revenues in the last fiscal year. Some of the factors that cause the analysts to select ADP, continuing expanding opportunities overseas, seen as a driver. The company has a long history of earnings leverage from automation. In other words, using technology to automate the payroll services, and that decreases their headcount, but yet increases their efficiency and margins. The expected recovery of U.S. businesses from the pandemic will help with future growth. So they had a little bit of a lean year, and the most recent quarter sales and revenues were only up 0.7%. But rising interest rates, again, will also help that interest income component of their revenues, and interest rates are going back up. When you look at the graph, again, this is a slow growth, large company, $14.6 billion in revenue in 2020. And the historic growth rate are around 4%. The historic earnings growth rate over the last 9-year period up to 8.7%. The analysts expecting 5% sales growth coming out of 2020, and earnings growth, per share growth of 10% with about a 2% dividend right now. And so that gets you to around 12%, which is a nice stable rate of return. You can look at the high and low prices each year for ADP, and they tend to be very constrained. They're very consistent growing business. The price just tends to go up. It had more of a fall off in 2020 when the market went south last March, April, but has recovered since then and is expected to continue its forward trajectory. The quarterly percentage pre-tax profit graph on a trailing 12-month basis, you can see this is their percentage of pre-tax profits. So it's been very stable up in that plus 20% range. It's fallen off a little bit in 2018, 2019, but it's been very consistent even through the second quarter of their 2021 fiscal year, which is where we are right now. That second quarter ended December 31st. The PE ratio history, again, very consistent with the high PE ratios, tending to be in the high 20s, low 30s, and the low PE ratio never dipping below 18, 17.9, 18.1. So again, this is a company that's valued for not delivering a lot of surprises, and what I would consider to be a core holding in a portfolio, one of those buy and hold, buy and forget kinds of stocks that will continue to deliver returns at the current price of $167. The analysts are looking at a high price of $295 and a potential downside price of $126, which gives you a 3.2 to 1 upside downside ratio, which is within our range. And on a total return basis with a 2.2% present yield and a 2% average yield, the compound annual total return is about 14%. So a little bit below the rates of return that we see from some other companies, but for such a high quality business, that is a pretty decent rate of return in a very frothy market. So that is the analysis of ADP, something for you to think about for your portfolio. Diane asks, what are Peo Services? That's the division that leases employees back to ADP, takes over a company's workforce. The employees work for ADP, but are directed by the client, the company client. And so that segment serves more than 500,000 employees in all 50 states in the U.S. So it's a pretty significant operation. And through that PEO services segment, the companies are able, or they can offer employee benefits because you're essentially got 500,000 employees. So you can really scale the benefits that if you were a company with 500 or 1,000 or 1,500 or 20,000 even workers, you wouldn't get the same benefits, the same economies of scale. And so that's how ADP can offer that particular business. Well, as we continue into this pandemic, I'm very excited. I live in Connecticut, as you may know, and tomorrow I get my COVID vaccine. Just opened up in my age bracket, and so I'm going in to get the shot tomorrow. I'm very excited. Our schedule for the time being remains virtual. So I've got money shows and better investing in AA chapter events scheduled through the year. And we're still hoping that by October, we might be able to meet in person at either the AA conference in Las Vegas or the Better Investing National Convention in Dallas. But this month, I've got the money show coming up on March 17th. St. Patrick's Day, I believe, is when I'm scheduled for that. This particular event, and then the South Florida Better Investing chapter will be doing their Investor Education Day on March 27th. And the value of these virtual events is that no matter where you are, you're welcome to register and attend these events. Often they have a nominal charge for them that benefits the local group. And then in April, I'll be virtually traveling back to Northeast Ohio for the Better Investing chapter there, and doing another money show. West Texas in May, more money shows, and then North Carolina's AA chapter in July. So plenty of events there. You can find the complete schedule and links. You can link from the handout if you download the PDF and click on the link there. You can do a Google search, or you can find the links on the Investor Advisory Service or SmallCap Informer website in the resources section. And that will get you the links that will get you more information about these events. And with that, hey, please feel free to email me with any of your questions, Gerlach at ICLUB.com. I'd like to hear your ideas for stocks that we might consider at our next session in April. So if you have a stock you'd like me to take a look at in our stock to study in the Tuesday Night Stock Club, please shoot me a ticker symbol at some point in the next couple of weeks, and I will consider it. As always, I hope you all stay healthy, stay warm. I hope your power's back if you're in Texas. I hope you're keeping warm if you're in New England, but stay the course. We're 2021 looking to be a year of big change from 2020, but hopefully in a positive direction for all of us. Thanks for coming out tonight. We'll look forward to seeing you at our next Tuesday Night Stock Club.